second issue of the Mobile Money Lit. And much as I'm going to thank my co-editors in a second, I also want to thank the staff at VoxDev and CPR. Without their hard work, this would just not be possible to produce. As Ollie mentioned, the lits are kind of living documents, a living lit review, where we can update it every so often once there's enough research, ideally once or twice a year. So this is the second Mobile Money Lit. Let me start off by thanking my amazing co-editors. Instead of using names, I decided pictures would be more fun. So a huge shout out to all of them: Jenny, Katya, Michael, Tarek, Billy, Leora, Emma, Simone, and Sandeep. They've all helped put together this lit that I'm going to present today. So let me start with a bit of an introduction. Mobile phones have been changing finance in the developing world. Mobile money is now in 96 countries with over 300 deployments. There's more than 1 billion accounts, close to now 3 billion worth of transactions a day in dollars, and 5 million agent outlets. And this has been happening over the last 15 years. And so the Mobile Money Lit is trying to understand what are the impacts of mobile money, and then what are proliferations that have come on top of mobile money that use the rails of mobile money to do more, and what are the impacts of those things. So that's kind of the broad agenda. Here's a description of mobile phones. You can see the growth in mobile phone subscriptions across the world. This shows it regionally for different parts of the world. And you can also see at the bottom, there's just subscriber penetration on the top set of numbers. The bottom set of numbers, for example, here would be smartphone penetration. So you've also seen this immense growth in smartphones coming along, especially in the developing world in the last kind of several years. Alongside mobile phones, you've seen kind of this growth of mobile money accounts or accounts on phones. Here's an example from the Findex database. If we look at the GSMA data, this is kind of globally over 300 deployments. That's the number I was talking about. And you can see the regional breakdowns. Sub-Saharan Africa has half of these 1 billion accounts almost. Is kind of the place where this started and took off in a big way. But it has grown in other parts of the world too. So this is what I'm going to do today. I'm going to talk about what is mobile money pretty briefly. I'll talk about the regulatory aspects of it, and then talk about impacts of basic mobile money services, which there's now a pretty large literature. It's kind of fun to see grow. Talk a bit about the added value services, briefly on the macroeconomic impacts, and then hopefully I'll have a few minutes at the end to be able to talk about where to next. So what is mobile money? It's basically the ability to use your phone like a store of value, to hold value. You do not need a bank account. So this is what makes mobile money completely different from mobile banking. It's not just a way to bank on your or interact with your bank account on your phone. It's a brand new payment system. You can store money, you can deposit money, you can withdraw money, and you can send money P2P via text. It works on dumb phones. There are smartphone apps, of course, but it was launched on dumb phones to start with. And you can see that's an example of M-Pesa, which is the mobile money product in Kenya, probably one of the most famous ones or well-known ones. The SIM card on a dumb phone comes with a little toolkit, which gives you that menu. To deposit and withdraw, because it's not a bank account, you need to have some version of a bank teller and ATM. They're going to use agents. These are sort of small stores. There's a picture of one there. You go deposit money by handing an agent money cash, and they kind of, do a little transaction on their phone that allows you to have virtual money on your phone. And then you can transact that money. If you need more, you go back to the agent. If you want to withdraw, you go back to the agent. So basically, the agent network forms the central backbone infrastructure for the entirety of mobile money. It doesn't work if there's no agents around, because your contact point as a consumer is always going to be the agent network. So that's kind of the basic workings of it. It does not have a bank account on the back end. The money usually sits in a bank account somewhere as a total amount, but there's no way for a consumer to interact with a banking system directly. So it's not actually an individual bank account for each person. It's a sort of a mobile money account, which has no connection to the banking system in a real way for any consumers. And I think that's important to distinguish, because there is a lot of ways to interact with your banking with the banking system on your mobile phones, right? I have a Bank of America account. I have an app. I can interact with it. That's not mobile money. That's just an app to use on my mobile phone to interact with my bank account. This is completely outside the banking system, at least when it started. Okay. So when M-Pesa launched, I'm going to talk about that to start with. It's kind of one of the products that has the most research on it because it is one of the early ones. When it was launched in 2007, Kenyans faced huge transaction costs of functioning with or transacting with the financial system. About a fifth of households of more than 20 kilometers from a bank branch. So what M-Pesa kind of is going to do, and mobile money in general is going to do, is lower transaction costs dramatically, especially on transactions that cross space. Let me give you a sense of what happened to the agent network. If you think about the agents, they're going to be pretty fundamental to kind of how mobile money operates because they are the transaction point. They are the infrastructure for consumers to cash in and cash out. So I'm going to show you a bit of this. This is kind of how the distance to agents changed over time. 2007 is when mobile money was launched in Kenya. You can see at that time, the average distance to a bank branch was 9 kilometers. Mobile money started at about 5 kilometers. In 2015, it was 1.4. It's now down to less than a kilometer. So it's really easy to interact with this infrastructure. When mobile money launched in Kenya, there was only 1,000 ATMs in the country. As we'll talk about and show you, the number of agents across the world, as I showed you the number before, was 5 million. In Kenya, it's 200,000. So the mobile money infrastructure has just been a core to mobile money and also grown dramatically as it becomes popular and used. Just to give you a sense of how this looks geographically, there's maps of Kenya. There's you can see kind of the first one on the left is 2007, then 2011 and 2015. And you can see this growth in the number of agents of all types, not just mobile money, but other financial agents, probably realizing that there's scope for more financial services given the expansion of mobile money. So you've seen this big implosion of access to financial services. The places that don't seem to have a lot is because population density is extremely low in those places. But it basically follows population density, but you can see this huge change and kind of the ability for households to access financial services. And this is kind of the transition that's been happening since 2007. Just to give you a sense of transaction costs, there are transaction costs in the system, often to withdraw and often to, when you want to send person to person, you have to pay a transaction cost to do that transaction. This is a sense of kind of the transfer fees in US dollars against the average transaction size. So they're not small transaction costs. They're not meant to provide an ability to do small transactions. In general, they're meant to be able to, do cross-space larger transactions. And so the transaction costs can be reasonably high. What you'll see is the alternative is delivering money in hand, in which case those transaction costs are way, way higher. So much as relative to the existing financial system, the transaction costs have come down, they're not zero. There's still fees on these systems. Can we talk a bit about the regulatory environment? As mobile money launched, it was kind of a very new thing when it launched. And so there was a bunch of regulation built around this product. How this regulation is implemented varies a lot by country, but there's regulation around how customers are registered. Often you need sort of a basic KYC around customers with an ID. There's regulation around the exchange and storage of e-money, sort of when you get cash, what you get in return is called e-money. There's often something called a trust account or a bank account that holds the float. There's regulation around what that account can do. Can it lend out the money or not? This varies by country. The regulators decide whether you pay interest on mobile money accounts, interest on the float account. What do you do with the interest? And then a bunch of places have reporting requirements, reporting aggregate transactions into the central bank, sometimes reporting repeat high value transactions. There's limits on transaction sizes and limits on how much you can hold in your account. There's often limits on foreign transfers. And then there's now starting to be regulation about interoperability, as every telco has started to launch their own mobile money system. There's some countries, for example, Tanzania, that requires interoperability. I need to be able to send money across telcos, not just within telcos. In India, they decided not to sort of follow the traditional mobile money that I've been describing. Instead, they decided to set up payment banks such that every mobile money account is actually a bank account. And they provided a government subsidized kind of payment system that makes it very, very cheap to transact between these payment bank accounts. But every mobile account is actually a bank account. So it's not even a mobile money account. I would call it a mobile banking account. And then given mobile money sort of came on the back of building these agent infrastructures, some countries started to pass agent banking laws. These sort of one of the first early examples, even before mobile money, was in Latin America and Brazil, where small stores or, grocery stores, et cetera, can take deposits to your bank account. And so a lot of mobile money was then followed by agent banking regulation. If mobile money agents can take cash from consumers, maybe they can also act as agents for the banking system. And so a lot of mobile money agents sort of became bank agents. If you want an excellent review of the regulation, Erin has one, so I encourage you to look at that. There's also this regulatory index put together by the GSMA, which tells you kind of how the regulation is. And so you can see there's still a lot of variance in regulation across the world for mobile money. Okay, let me talk about adoption and then I'll do impact. So this is M-Pesa again. This is going to be an example just because it's one of the early ones. And so we can see years and years of adoption data. You can see this immense growth. It was launched in March, April 07. On the left side, you can see customers. On the right axis, you see agents. And you can see kind of by 2015, they've hit about 25 million subscribers, which is pretty much every adult in Kenya. And there's over 130,000 agents. Okay, the banking infrastructure, remember I said, was 1,000 ATMs, less branches. And so this is already 130 times the banking infrastructure. And so access has just become a non-issue for mobile money. This is M-Pesa adoption by poverty. This comes out of surveys that Billy, Jack, and I did starting in 2008 to understand the impact of mobile money. And you can see much as, the poor started off adopting less, they caught up pretty well. And in fact, by 2014, almost every household had a mobile money account. I think we're now getting to almost every individual having a mobile money account. And then just to give you a sense of speed of adoption, this has been super fast. So on this graph, I'm showing kind of the slope of these lines tells you how fast things are adopted. All of the other ones, except for cell phones and M-Pesa, are all in the US. Tells you how fast each of these things was adopted, the computer, the automobile, the telephone. You can see cell phones in Kenya faster than any of those, and then M-Pesa is just lightning fast adoption. And this is kind of followed in a lot of places. As countries allowed and built regulation to allow mobile money, it's gotten adopted pretty fast in a lot of developing economies. So factors in success, I'm just going to highlight some of these. Again, the lit is just a little more detailed on this. But, a lot of the factors in success work, people trying to understand why it was so successful, point at kind of the agent network, just having agents everywhere. You saw the sort of growth in agents on those maps for Kenya, and that seems to be true a lot of places. How the agent quality, the management of e-money and cash inventories. There's some work showing the regulatory environment matters, as does, of course, mobile phone penetration rates and adoption. And then others sort of point to the trust and the brand of the telecommunications company. And then there's I want to sort of point out 3 extra studies that try to do, not just qualitative or correlational work, but actually kind of a bit more rigorous work. There's a paper using an RCT to show cost barriers in Gambia. That's pretty neat. They try to lower cost barriers and see that this is still kind of a huge issue. Corridor in Mozambique try to, vary in an RCT the gender of the sales representatives who are trying to get mobile money take up, and this seems to matter. And then Francis Anand has a couple of papers looking at mobile money agents and overcharging and how do we reduce that behavior, because if there's not great information about the actual fees, they might overcharge. I think I mentioned a bunch of these. These are sort of similar qualitative studies around kind of not just the regulatory system or agent network, but also kind of the business model, the design of the product, network effects, people still finding financial literacy matters. And then Kahn and Blumenstock have an interesting paper where they try to look across a bunch of different countries. I think it's 5 or 6 countries. And they use machine learning to look at whether there's a single set of characteristics that explains adoption across all, and they don't find this. So it seems to be pretty unique to every country what matters for success. Okay, let me shift gears and talk a bit about impacts now, which is kind of the bigger piece, I think, or the more fun piece, perhaps. So like I said, all mobile money systems have transaction fees. I already showed you that. This doesn't encourage cashless or retail transactions like credit or debit cards in the US. I will talk at the end about, a product that has launched in Kenya that allows the retail piece costlessly for consumers. But, when it launched, it was not like a credit card or debit card because the fees were paid by the consumer. So it was initially used to make 2 types of transactions, either geographically disparate transactions across space that travel 100 kilometers, 200 kilometers. Think of these as internal remittances within the country. And the second is kind of transactions where people will put money in their accounts because the opportunity cost of holding cash is high. Think of high crime cities. And there's a paper showing that this behavior does happen in Tanzania, a nice paper. So for these types of transactions, what does mobile money do? It's going to just dramatically reduce transaction costs relative to how these transactions were conducted before. It's also going to provide improvements in convenience, security, time taken, etc. So in that, let me kind of explain kind of how we thought about mobile money when we started our work in Kenya, and then I'll talk about all the research that's come after that. So basically, we all know that financial resilience is a key part of financial well-being. What does financial resilience mean? Well, if bad things happen, can you deal with them? And how did people do this? Social networks, right? In development economics, we know this. It's been shown in many, many countries that we use our social networks to smooth risk. But the thing is, if I want to smooth risk, imagine Ollie is in my social network. Ollie, sorry. It might not be of that much value to you given you're in England, but imagine he was. If we have this agreement that when something bad happens, we're going to help each other, money actually has to move from one person to the other. Okay, how is this done? It's usually handed to a bus driver going that way, or you jump on a bus yourself to deliver it. These transactions all existed in Kenya before. There was risk sharing in social networks before. What happens with mobile money is a lot of these transactions then dump on the mobile phone. This means they're much cheaper than bus rides, Western Union, any other version of things. They're quicker, they're faster, they don't get stolen, they don't go missing. So all of these things start to matter. And this is what we found. We basically found that if we look at households that had M-Pesa versus didn't, when there's a negative shock, when there's a bad event, they're better able to smooth consumption. Right. So the non-users, when there's a bad event, their consumption falls. They can't really smooth consumption, but for others, it actually doesn't fall. In fact, goes up a bit. I'll explain why it goes up a bit in a second. So we looked in particular at health events, unexpected health events. Here you can see that what happens when there's a health event for non-users, their total expenditure doesn't change much. But for users, it goes up. So our natural thought was like, oh, they're spending on medical care because it's a health event. So we look at medical care, and it turns out both users and non-users spend on medical care. What's the difference? The difference is the people who don't have mobile money are taking it out of other parts of their budget. They take it out of non-food. Some of this is education, sadly, and food. They're going to reduce other things to be able to pay for healthcare. Okay. The users instead don't have to cut those and in fact spend more on food and non-food items. Okay. And this is because in the data, we see that they're more likely to receive help. They receive more help and they receive help from a bigger network. They're able to grow their network. Okay, and this is because the transaction costs went down. And so I can now interact with people who might have lived very far away and who's, before if it's through a bus, they just live too far away to transact with. Now that everything's on mobile phones, the transaction cost is not a function of distance. And so I can. So we find these improvements in resilience that come from mobile money. And you're going to see similar results now in a bunch of places. I'm going to talk about them quickly. Tanzania using a different diff. This is Emma Riley's work in the JDE. There's new work by Katya and Pedro showing in Mozambique using an RCT, very similar consumption smoothing results. In fact, they also then see that there's disinvestment in agriculture and some migration as a result. In Uganda, using an RCT, there's a paper showing impacts on food security. A PEDI shows for a large sample of developing economies, there's reductions in consumption volatility. In Tanzania, again, poverty smoothing, and as a result, investments in human capital. In Kenya, looking at health shocks in a different context in Western Kenya, they see spending more in healthcare through the use of these informal relationships or loans. Lee et al. Look in Bangladesh, and there they look at matched they look at households that have a migrant in Dhaka. So they're looking at a different sample. But they find that mobile money has positive effects on the rural migrants, but then has negative physical and mental health on migrants in Dhaka, maybe because they feel like they have to work harder to help their family. And then in Afghanistan, Josh Blumenstock and all have a bunch of interesting papers. The first one, sort of directly mobile money related, is just showing that when there's violence, people want to increase cash and use less mobile money, sorry. And the reason is they might not be able to withdraw it if something happens. Great. And then after that, there's been also a bunch of other papers trying to show impacts on other outcomes, not just kind of consumption smoothing and worrying about shocks, but also, does it do anything else? So there's a paper showing increased savings in Kenya, in Uganda, the increased take-up of antenatal care, food security level improvements, not just in response to shocks, level increases in consumption in Uganda, women's empowerment in Kenya, and then Plyler et al. Is sort of trying to look at community level effects in a qualitative study. And then again, another women's empowerment study in Kenya. So kind of a broad other range of outcomes across the literature that people are finding. And then longer term effects, I think at the moment, just one paper so far. It's our work that follows up M-Pesa from 2008 up until 2014. And we see a reduction of 2 percentage points in poverty. So close to 200,000 households move out of poverty, of extreme poverty, as a result of M-Pesa. We also see kind of a bit of this start, possibly, of structural change, in that women are switching occupations from farming to being in a business. And the Pedro Katya paper has also this favor, right? In Mozambique, they're seeing a switch out of farming and some migration, with the idea that maybe this is the start of some more kind of structural transformation type stuff. And still yet to be seen. Just a plug, we have another survey that we conducted after this. So hopefully there'll be some even more longer term effects coming soon. Okay, let me talk briefly about the work on microenterprises, because this is all on the household side, but there's also been a blossoming of literature around how do microenterprises do with mobile money, and does it help them? So Katya et al. Have a paper on mobile money accounts and financial management training in Mozambique. And they find positive impacts on the performance of female-owned businesses, but not on male-owned. Emma Riley has a very nice paper looking at the disbursement of loans from microfinance and whether it's in cash or in mobile money. And this is for women entrepreneurs. And she finds that the loan disbursement into your mobile money account increases the value of business capital and profits. And she shows very creatively it's coming from an improved ability to resist sharing pressure from the spouse. When the woman has cash in hand, she kind of has to share it with her spouse, and less likely to do so when it's in her own mobile money account. And then Agarwal et al. In Malawi try to vary the cost of using mobile money for entrepreneurs or microenterprises. They do find that these accounts are open and used when we reduce the costs, and some of the entrepreneurs shift labor from business to agriculture, kind of the opposite of what we're seeing on the household side. And they also show it's not being used for transfers, actually, it's being used by the entrepreneurs to save. Okay, I'm going to do a couple more slides on extensions of mobile money, and then we'll talk about digital banking. So there's a bunch of papers now trying to use mobile money as rails to deliver other financial services. Can mobile money act like a different, a way to distribute cash transfers, a way to do salary payments? So Jenny and all have a paper with cash transfers and mobile money showing improved nutrition. Blumenstock and all show kind of shifting, using mobile money to do salary payments rather than cash. They don't see much impact on the people receiving it, but it's certainly cost effective for the person who's paying salaries. Another Blumenstock and all paper is saving products. They built a savings product on mobile money with matching, and they look at what that does. And then Emily Breza and others have a case in Bangladesh where they shift from cash to digital wage payments, where they show there's evidence of learning by doing once you start moving kind of wage payments into mobile money. And then there's a bunch of kind of savings related papers where people try to use labeled accounts or use mobile money as savings vehicles. So Kenya, Mozambique, and Apeti and Edo for a large sample on tax revenues. So basically you're seeing that there is a way to encourage savings on the system if you incentivize it, and then it's also increasing tax revenues. Okay, I'm hoping to spend the last 10 minutes, well, 8 of the last 10 minutes on value add services, and then 2 minutes, so I'm not running out of time, on where to next. So much as this is all using mobile money to either to understand what mobile money itself could do, or to like prompt people to change other versions of financial behavior using mobile money, there's also been recent growth in value add services over. The biggest one, or pretty much the only one, has been fully digital banking. So this started in Kenya, but it's now in a bunch of other places where you can build a digital banking wallet over mobile money. How does it work? I have a virtual account. It's now in the banking system fully. It's a bank account. I put money into my mobile money account and then transfer it to this wallet free of cost. In that wallet, it's going to earn interest because it's in the banking system. I can borrow because it's a bank account and I can get credit. If I want to withdraw it, I put it back into my mobile money and withdraw it from the mobile money agents. So again, this still uses mobile money as rails. It's going to use the agent infrastructure as the cash in, cash out for the bank account, but it's going to be a true, fully digital bank account. The first one was launched by CBA in Kenya, probably the most popular right now in the world. And it uses, like I said, the rails of mobile money. CBA did not have a lot of bank branches across the country. And so this means they can run a bank account without needing branches, right? Because the rails of mobile money provide the cash in, cash out. They don't have tellers, they don't have loan officers. They use your mobile money data to build a score to decide whether you get credit and how much. And this is a way of just lowering the costs of banking, both for the lender and the bank itself and for consumers. Okay. This sort of bank account is now in a bunch of countries. There's also been a growth in pure digital lenders where they just offer credit on a digital app. Branch and Tala, sort of the two big examples coming out of the US that are now in developing countries doing digital lending. Just to give you a sense of the market in Kenya, because this is probably the most active, there's now over 200 or 300 lenders. This is from a few years ago, there was 15, but most of them are pretty tiny. The big ones were M-Shwari, a copy of M-Shwari coming out of Kenya Commercial Bank, and then others. And they're all offering very short-term loans at pretty high monthly interest, 6 to 12% a month. So, on the digital bank account and the digital credit, there's a piece that's about digital banking, which is just having a bank account that you can save and earn interest in. And I'll talk about those first, and then I'll talk about the digital credit side. So in Tanzania, there's a paper showing these mobile saving accounts on Empower. Empower is the same product in Tanzania as M-Shwari. And they see that, it does move savings out of other places into the mobile savings account. It allows women to get more micro loans, because one of the ways you can borrow from that digital bank account is by holding savings. They use that as a signal for lending. And they see an increase in women's self-reported control over how their money is spent. In Kenya, James and Billy ran an experiment in schools where they offered students savings account on M-Shwari and a commitment savings account. They see an increase in savings and an increase in enrollments. In Ghana, Emma and Abu have a paper looking at whether you can get better adoption of these bank accounts, these digital wallets, using an IVR sort of encouragement design. And they do see kind of, there's more bank transactions conducted this way, and it reduces the visits to bank branches. So it does save transaction costs for the consumers. On the digital credit side, I have a paper with Prashant and Billy looking at the digital loans piece of M-Shwari, just looking at an RD around the credit score cutoff. We see huge take up of M-Shwari loans, but it doesn't substitute for the credit. So it's a true credit expansion. And we see sort of resilience effects. It helps smooth health shocks, it improves resilience, and it increases the propensity to spend on education. And that's probably because, as we showed in our earlier mobile money work, when non-users of mobile money have a shock, they're cutting education to spend on health because everybody treats health as priority number one. And so we think that's where the increased propensity to spend on education is coming from. And then Dan Bjorkegren and others use an RCT to study a digital loan product in Nigeria. They do see it increases measures of subjective well-being. And they also vary in the RCT the size of the loans conditional on approval, but they don't see that has any impact at all. In Malawi, there's a study using an RD and an RCT on digital credit and financial literacy. Here, the credit seems to harm consumers' own perceived well-being, actually. So it has negative effects. And then the financial literacy treatment increases knowledge and actually increases the demand for loans. It doesn't make the loans more likely to be paid off. And so you see more default in aggregate because there's this demand effect on loans of the financial literacy. So, clearly things that have to be thought about carefully in this context. So that's all on the digital credit side. Like I said, there's very little product proliferation. It's all just a credit product. And it's all pretty short-term credit in general, usually very short-term, like a month. Finally, I want to give a shout out to this study. So retail payments have lagged a lot on mobile money. And the reason is because there's transaction cost to the consumer, right? So if I have to, if I'm going to buy a bottle of water, for example, for 25 cents, I don't want to pay 5 cents on that. It makes no sense. So the telco in Kenya, Safaricom, launched a version of M-Pesa they call Lipa na M-Pesa, whereby the retailer takes on the transaction cost. So this starts to look like a debit card, right? Where the retailer pays, we don't pay the transaction cost. And so there's an RCT looking at the adoption and impacts of this e-payment technology, Lipa na M-Pesa. And they see that it increases the access to digital credit for these entrepreneurs who use this. It reduces the volatility in sales, especially for smaller firms, but it doesn't change revenue and profits. Okay, so the retail piece is mattering more for smaller firms. And hopefully we'll see more and more of this innovation on trying to get the retail payments piece onto the payment. Very quickly, macroeconomic effects. This literature is mostly focused on whether it's creating inflation and changing the velocity of money. And this seems to be pretty much no from the set of papers. I'm not going to go through them here, but it seems to be that, mobile money isn't changing inflation all that much. It's not changing the velocity of money all that much. And it's probably because it's mostly used by poor people with very small transactions and not used as much by the high end of the income distribution. Okay, I think I have a couple minutes left. So I'm going to try and spend a couple more minutes talking about where to next. So this is the gender gap in mobile money usage in low and middle income countries. Thanks to Emma Riley for this graph and the Global Findex, which is collecting all this data. And you can see that there's still a long way to go in terms of both level access as well as the gender gap in mobile money usage. There's a lot of work showing now that women really benefit from these accounts. And so trying to understand how to reduce this gender gap is going to be important, and there's still a really long way to go. I think the other piece is, despite all these gains from technology, there's still an even longer way to go. There's less use of digital payments for P2B, I think person to business, B2B, business to business, and G2P, government to person. Though COVID has really started to change that, right? A lot of cash transfers over COVID were going over mobile phones because it was the easiest way to do it. But there's still a long way to go to think about how this is truly a financial system innovation, not just a payment system for a very specific type of transactions. So I think that still lots to do. You know, the other piece is how to liberalize and democratize these payment systems. So thinking about identity and financial services, but also thinking about APIs, right? M-Pesa is an API, but it's not used that much. How do we get these rails? As I said, you know, I like calling them the rails of mobile money. It's a bunch of I think of them as train tracks, right? And you can build all the train tracks you want, but then you need to also build the wagons that go on the trains, or, you know, the wagons that go on the tracks. And APIs is a way to have more wagons on the tracks, right? So that's still really lagging. And then, you know, the biggest piece for me that's really been kind of surprising and not positive, is surprising, is products, right? Mobile money has been around in Kenya since 2007. I've been working on it since 2008. It's a really long time, I promise. But, you know, the only product that's really been built on it that's being used is this credit product, or, you know, digital bank account. You would think that there would be a whole set of financial tools over the system that would help people live their lives. The credit product is literally a monthly loan. How many people really want and need or can use a loan that has to be paid back in 30 days? There's just really no innovation on product design. And that to me seems like the big missing piece here. And I think where the welfare and profit gains are going to come from next. How do we get a set of products, a diversity of products that really help people now that we have these great rails that everybody has access to in some of these economies? So I think that's where the gains are going to be. I'm going to stop there. Thank you very much for listening. I'm hoping we have time for some questions. Ollie, I think I'm right on time.
Yeah, you are. Thank you so much for that presentation. Yeah, we have lots of time for questions, so I'll get straight into those. We have two from Abby Kadir. The first is there any research on mobile levies or taxes, kind of thinking about whether governments would be able to use mobile money as a way of expanding their tax base? And then his second question, or their second question, is about whether there's trust and safety issues to participants of mobile money transactions, for example, to do with data and that type of thing. So yeah, I guess we'll start with those two, and then there's a lot more. And if people want to ask more, then yeah, feel free to submit that.
So good, both good questions. There's two ways of thinking about taxes. One is, do you tax the transactions themselves? This has been done in a couple of countries, and I don't know that I've seen a paper on it, but I've heard that there's a dramatic reduction in transactions because of the tax. So I would encourage policymakers to think carefully before taxing the transactions. The second is whether you'll use mobile money to raise taxes, and that's certainly been done. There's a paper I mentioned earlier. I'm not going to remember it because I mentioned too many papers, but it's there in the lit, where the growth of mobile money has increased tax revenues. And this might be because people are informally using it to collect taxes in some way. It might also be on a business, you kind of are better about paying taxes because you have better records. So unclear why, but I think there is that. On the trust and safety issues, I think for sure trust in the mobile money system or in the telco really matters. That's certainly true. I think there's been very few cases of fraud, and most of them come from, you know, someone getting access to someone else's PIN for the mobile money account, right, in general, or someone from internal to the organization being able to do something. But in general, the transactions are pretty secure. The other thing is, you know, the amount in mobile money accounts is quite small for each person. And so it doesn't encourage a ton of crime. I don't want to hold someone up for $3 in their account. If I really want to hold someone up at gunpoint, I want someone who has a bank account with lots of money in it. And so I'm going to, you know, drive them to an ATM and have them empty out their ATM, right? So it's not I think as a transaction device, it's been pretty safe because the amounts are small. It's really hard to hack. But there have been fraud cases, but most of these are because someone got access to PIN numbers. So in general, don't share your PIN number with anybody.
Great. And then we have another couple of questions. One from Christian, who asks about how the fact that these long distance kind of remittances between different people in the same country have become easier, and how that interacts with village social nets and people's migration decisions. I think we went into it a bit, but yeah, maybe some more on that. And then also Rada asks about the negative impacts of digital credit in relation to kind of evidence on over indebtedness. So whether the fact that companies might start offering these credit services using mobile money, if that could have any effects on people who are already over indebted.
Good. Okay, I'm going to try both of those. On social nets, good question. So in our work in Kenya, we see an expansion of the social net or social network, I should say. Now, let me put it this way. We see that you get more transactions from more different people than when you don't have mobile money. So I don't think the expansion of social networks is coming from trying to find someone you don't know and integrate them into your social network. I think it's someone you knew, but did not have in your social network, or we didn't see financial transactions with because they live too far. What happens before mobile money is, I'm going to use very traditional tools to get money. As I mentioned, if I'm risk sharing with Ollie, I'm going to try and either go to the banking system or give it to a bus driver. Most of ours were delivered by hand, actually, before mobile money. Okay, so I give it to a bus driver or I give it to a friend to take that way. And the transaction costs are quite high. It often gets lost. This is a pretty high cost system to use, but it existed. But because it's going by bus, of course, the fee I'm charged is a function of distance. So if Ollie lives 100 miles away, it's going to be cheaper than if he lives 1,000 miles away. So I think what we see in our data as a result of mobile money is we see you get more different transactions, you get more remittances and from more different people, and those different people live further away. So basically, I can now reach people who who live 500 miles away, because before it was just too expensive to financially interact with them, right? If I called Ollie and he lived 500 miles away and said, Ollie, I need some Tylenol for my kid, he's going to be like, so I'm going to spend $5 to get you 25 cents? I don't think it makes sense. But the nice thing about mobile money is it's going to break the distance transaction cost link, right? Whether Ollie's standing next to me or 1,000 miles away, the transaction cost of mobile money is going to be the same. So we do see an expansion in social networks and an expansion in who you transact with, for sure, in our data. I don't know that anybody else has looked at that explicitly. And then on the migration, we don't see migration effects in Kenya, but in Mozambique, Katya and Pedro do see effects on migration. They see people start to migrate. They sort of are de-investing in agriculture and starting to move to other things. And some of this might be because they can access financial systems and information systems that are broader. The second question was about over-indebtedness. Oh, good. So it's a good question. To be honest, we spend a lot of time thinking about this in our digital credit study on Mshwari. It's not even clear, and this is something I've been working on separately, so maybe we'll have a paper on this soon. Everybody uses over-indebtedness, but there's no real true definition of over-indebtedness. So we've been trying to build one that you can compute from data. So hopefully we'll have a paper trying to argue why we need a particular definition of over-indebtedness. But we did try to measure it in Mshwari, just looking at interest costs, and we don't see a big change in that. So I think it's just, people just don't have very much financial access. So for now, that's not a problem. It doesn't mean that, cycle 10 years forward, it's not going to be a problem. So it's something we should monitor. But given a lot of people just didn't have loans, and this is truly expanding credit for the first time for a lot of people, it's not yet a problem. And we didn't find any effects on the level of indebtedness of Mshwari. But like I said, it is sort of people who don't have a lot of credit. And once they do, this might start to become more of a problem. Ollie, back to you. I can't hear you, Ollie.
Can you hear me now?
Yep, I can now.
Okay, sorry, yeah, my headphones literally just ran out. Yeah, so we've had a couple other questions. One has asked whether we can share these slides by email, which I'm sure would be fine, but also everything obviously in this presentation is covered in the lit, so we would say maybe check out the lit as well. So two questions, one from Seneschal, who's asked about how kind of the access to mobile phones and therefore mobile money kind of differs across different developing countries and in rural areas of different developing countries, and whether there's an important or large effect of the actual cost of acquiring a mobile phone to then be able to use the mobile money network. So that's one question. And then we've had a couple of comments as well, going back to the point that someone raised about using it for tax, saying that in Uganda and Ghana, they've tried to do a tax and it's actually had like quite negative effects. So that's just some feedback to that previous question. But yeah, maybe if you address the question by Seneschal about kind of differing access across different places.
Yeah, I was thinking of the Uganda and Ghana cases on taxes. I was in Ghana a few weeks ago and I heard that it really had a huge negative impact on transactions. I have yet to see this in data. So if someone wants to write the papers, please write them and send them to us so we can add them to the lit. On phone adoption, again, I'm not going to know anything off the top of my head in rates and actual numbers. There's a couple of pictures in the lit that are pretty detailed on adoption. They're going to be aggregates for countries. The Global Findex, can I give them a huge plug here? The Global Findex is probably the biggest data source on those pure numbers that you might want. It's collected in a bunch of countries now. And the microdata is there. So you can go look at rural urban. They don't really break out all of these bits and pieces you might want to look at, but I promise you, go download the Global Findex. You'll be able to check country by country what these are by rural urban. My guess is, my reasonably well-priored guess is that rural areas is going to be lower than urban. That's true in Kenya. And I showed you the gender one. It's still lagging by gender a lot as well. I think the cost of mobile phones is not so high anymore because a lot of the mobile phones people are using are not smartphones. They're using these dumb phones that are not also new ones. They're mostly kind of refurbished ones coming from elsewhere. And then, if it is, there's interesting cases. I think Pakistan is a case of this where a lot of the transactions are over the counter. So I don't even need a phone. I ask the agent to do the transaction for me. And so you could see lots of OTC transactions over the counter if phones were a constraint. So I think there is a way around for mobile money where phones are not the constraint. And I think, I'm not sure the Global Findex collects this, but my guess is they do. They'll know how many are over the counter and how many are from your own phone. But in a lot of African countries, they're on your own phone or at least one phone in the household. It's unusual to have. It's now becoming more common, but it was unusual to have more than one mobile money account per house.
Great, and then maybe we have time for a couple final questions. So Richard has asked about whether there've been any studies on how the effects of mobile money if they have any effects on how the spread of commercial banks kind of evolves. So whether it replaces it, complements it, how that works. And then we had another point as well about how in Kenya they've kind of introduced a transaction cost and then a VAT as well on each transaction. And they asked kind of what your opinion is with respect to this discouraging the use of digital financial services. And then I guess another question I'd have on top of that is, what can governments do to encourage or kind of facilitate the spread of mobile money if it does have these positive effects you talked about on resilience and other outcomes?
All good questions. Am I going to remember all of them, Ollie? One was taxes and VAT in Kenya. What was the one before that? Oh, impact on commercial banks.
Yeah.
So that's a great question. I am working with a couple of people to actually try and answer that question. Mostly because there's also agent banking regulation that comes in. So mobile money agents can actually be agents for the commercial banking system. And so we're trying to do some work around understanding whether, exactly what I showed you is causal or not, right? That this proliferation of other financial services, was that just accidental because the country is growing, right? I can't tell you that right now if it's causal. So there isn't anything at the moment, but we're working on it. And there's actually also people working on the interoperability piece too that I know of. So certainly a few things happening in that space. Check back on our next lit, I hope, fingers crossed. On the taxes and VAT, yeah, I don't know. I probably shouldn't, I think everybody knows this by now, but I'm Kenyan. I probably shouldn't comment on Kenyan policy in an opinion way in public. But I think all of the tax systems that have been implemented do have an effect on transactions. They do go down. That seems to be the anecdotal evidence. Like I said, for Ghana, Uganda, it's been a while. I would love to see some real quant evidence of how much it changes these impacts that we're seeing. Do they disappear? Do they stay because of, I don't know, kind of hysteresis or something? So I think there's a lot of questions there that are completely open and important to understand. On the government policy side, more generally, I think before taxing, be very careful. In our paper, we find the impacts of consumption smoothing are even bigger at the lower end of the income distribution, which is not unusual because the rich have access to other ways of dealing with shocks. They have insurance, they have all sorts of other things, right? So I think if the taxes are really reducing transactions, the question is which ones and for whom. And then maybe the incidence of the tax is not great, right? But I think we need to think very carefully about that. Is where is the incidence falling? So that's a plea to all of you out there listening to do some work on this. I think there's some really important questions there to understand. On government policy in general, I think the first is, sort of allowing systems like mobile money, which some countries still haven't done. That's one. I think the second is kind of figuring out a way to sort of, like I said, democratize the rails in some way, right? I think of, yes, the telcos are building these infrastructures of agents, which is really great. And you can keep that agent network closed, but it shouldn't be allowed forever, right? It's like, in my mind, a bit like IP. I give you some time, you can make some money, but at some point, the rails are really good for the world and we need to democratize them. We need more wagons on the rails. And so I think that's a place that government policy can be creative and have huge welfare impacts, is thinking about these infrastructure pieces of mobile money and how do we best encourage their use, but not discourage the investment, right? And I think that's the place where I think it's going to be most important going forward. Yeah.
Great, thanks so much. I think that's probably all we have time for today, but I will download the questions and then I can send them over to you to see if there's any more that you would want to respond to. Thank you so much to everyone who attended today. I've just put in the chat a link to where you can download issue 2 of this VoxDevLit, and yeah, the whole purpose of these is that over time they're going to be continually updated. So as more research is done in some of the areas that we discussed at the end in the Q&A, these will be reflected in future versions of the VoxDevLit. So yeah, thanks again, Tavneet.
Can I say one thing, or two things rather? One is, if we did miss work out there, apologies in advance. We're human, please send it to us. We'll be happy to put it in the next issue. This is the beauty of living lit reviews. There's no such thing as missing work because there's another version coming. So please feel free to email me directly if you want, or Ollie, and send us stuff. The second is, if people want to talk more and have other questions, you're also welcome to email me directly. Thank you all for being here this morning. Or this afternoon, wherever you are in the world. I really appreciate it. And thank you on behalf of the whole VoxDev board and team.
Great, thank you so much, everyone. And thanks, Tavneet.